Neal, thanks so much for your time. So tell us why you've decided to host investors today.
Yes, good afternoon. Every year to 18 months, we generally get our investors, analysts, and even the media together to focus on a portion of our business. As you know, we are a rapidly growing company. It creates a lot of misunderstanding. There's a lot of complexity involved. And every now and then it's appropriate to have a very focused discussion, not just a results announcement, but a focused discussion on the strategy, on the assets, and that's what today is about.
And you began your presentation with the issue of safety. Your safety record is not the best. There's a lot of concerns that you're not doing enough to address mine workers dying on the job. Is this an accurate view?
It's not really an accurate view. You know, if you measure safety in quarters, yes, we've had a very bad quarter. If you look at our safety performance over the last year or even 5 years, we're one of the best safety performers in the industry. Our company has grown. We probably have 3 to 4 times as many people in our company compared to the next largest deep-level gold mine. So inherently we will be seen to be having more accidents. But if you measure it in frequency rate, which is dividing by the number of people you employ, our safety record over the last 4 or 5 years is actually one of the best. That does not detract from the fact that in the last quarter we've had an unusual amount of safety incidents, and we are addressing that. That's not acceptable.
You've hired someone who's doing a PhD in safety to help you manage that better. Tell us a bit about that.
Well, we've done a number of things. One of them is having a very focused initiative on behavior. But today we announced that we hired Dr. Kobus de Jager, who's doing his second mining PhD on safety, and we've brought him in to help us turn around the current bad trend that we're experiencing.
In an update on the Lonmin transaction, I'm quoting yourself, you essentially said that, Lonmin needs this deal to survive.
Oh, absolutely. There's 20,000 employees that are dependent on this deal going through to survive and benefit. Of course, there are a number of employees that are going to lose their job, but whether this deal goes ahead or not, those shafts are coming to the end of their life, and unfortunately there's about 12,000 current employees that are going to lose their jobs anyway, whether we buy it or not. But what we can do is we can potentially save another 20,000 jobs instead of seeing 30,000 jobs destroyed. That's in the national interest, and we're quite prepared to step up to the plate to do that.
I mean, you mentioned the synergies that this deal will provide for your shareholders, but you can imagine workers won't be too happy about the fact that around 12,000 of them will be jobless. How do you intend on navigating that headwind, the resistance from workers to this deal?
Yeah, you can't talk about the synergies and the 12,000 job losses in the same sentence, because they're two completely different things. The synergies that will flow through don't just benefit the shareholders. In fact, all it does is positions the combined company to survive what we expect to be another 2 to 3 years of depressed platinum prices. So the synergies don't flow through to the shareholders. The synergies flow through to the business, which then gives it sustainability.
But the workers, though, the resistance you may face from workers who don't want to lose their jobs as a result of Sibanye Stillwater getting even bigger through the acquisition of Lonmin.
Well, as I've said, there's 12,600 jobs that are lost whether we buy the asset or not. It's got absolutely nothing to do with the transaction. These are Lonmin shafts that are coming to the end of their life. And the sad thing is that if we don't buy the assets and create the sustainability that I've just described, there's even more employees that are going to lose their jobs. Now, what we have to do as an industry and as society, we've got to try and mitigate the impact of job losses. But it's really not a Sibanye caused issue, the initial 12,600. I need to make that very clear.
Right. So your debt profile is looking pretty high. You've bought quite a number of assets, and a debt has resulted as a result of that. The market is quite concerned that there might be a rights issue as a result of this. Are these concerns founded?
Look, the concerns are real. So we do have high leverage, having purchased the US assets, which are the best PGM assets in the world. We took on a lot of debt. The market is concerned about that high leverage, and there's an expectation that we may do a rights issue. We have said many times, more recently, that that's not being planned. We have a number of alternatives. The one that we're looking at that is very cost competitive with our current cost of debt, and it's an equity-like instrument, but it doesn't use equity, is that of a stream. And that probably can be put in place in the next 6 weeks to 2 months. It's something we've been working on for probably almost a year now, but the changes in US tax laws actually caused us to redesign the structure late last year.